In 2024, the S&P 500 gained 25%. Most investors didn't get anywhere close to that. According to Dalbar's annual investor behavior study, the average equity investor captured only 16.5%. More than 8 percentage points disappeared. Not during a crash, not during a recession, during one of the best years in the market. So where did the money go? Wall Street has a convenient answer. Investors picked the wrong stocks. They mistimed the market. They didn't have the right strategy. But 40 years of data point to a much simpler explanation. The greatest threat to your wealth isn't inflation. It isn't interest rates. It isn't even the market itself. It's you. And the most expensive financial mistake you'll ever make may happen in less than 11 seconds, because every investing disaster begins the same way. A screen, a number moving in the wrong direction, and a hand hovering over a button. What happens next determines whether decades of compounding survive or die. Most people think investing is a competition. Find the best stock. Find the best fund. Find the best strategy. Beat everyone else. But what if that's the wrong game entirely? Benjamin Graham understood this nearly 80 years ago. The legendary economist and investor taught that the market behaves differently depending on the time frame you're looking at. In the short run, he said, it's a voting machine. In the long run, it's a weighing machine. Prices swing wildly based on emotion. Eventually, reality catches up. One of Graham's students took that idea further than anyone else, Warren Buffett. For decades, people searched for Buffett's secret formula, his hidden method, his investing genius. But Buffett's greatest advantage wasn't intelligence. It was endurance. He stayed invested, while others panicked, while others chased trends, while others constantly changed direction. He sat still. And that's where the story gets uncomfortable. Because modern investors have access to more information than any generation in history. Yet they continue to underperform the very investments they own. Over the 20 years ending in 2024, the S&P 500 compounded at roughly 10.3% annually. The average investor earned about 9.2%. That difference sounds small. Just 1 percentage point. But over 20 years, on $1 million portfolio, it creates a gap worth hundreds of thousands of dollars. Same market, same opportunities, different behavior, and that's where the real problem begins. Imagine opening your portfolio. Everything is red. The market is falling. Every headline predicts more pain. Your account balance is lower than it was last month. Maybe lower than it was last year. You know what you're supposed to do. Stay calm. Stay invested. Ignore the noise. But knowing something and doing it are very different things. And history shows most investors fail this test. In 2018, the S&P 500 lost just over 4%. Painful, but manageable. The average equity mutual fund investor lost more than percent, more than twice as much. Not because they owned worse investments, because many sold during the decline. The market didn't create the extra loss. Investor behavior did. And this isn't a rare event. It's a recurring pattern. People buy after prices rise. They sell after prices fall. They seek safety precisely when risk is already fading. And they seek opportunity precisely when prices have already become expensive. The result? They repeatedly transform temporary volatility into permanent damage. Most people remember 2008, but the real wealth destruction often happens in dozens of smaller moments. Nobody remembers. The quiet corrections, the ordinary downturns, the random scary headlines, tiny decisions repeated over decades, each one shaving away a little more of the future. In 1975, Jack Bogle proposed something radical. Stop trying to beat the market. Just own it. His idea became the index fund. At the time, many professionals dismissed it. Why settle for average? Why not hire experts? Why not find the next great stock picker? But decades later, the evidence became difficult to ignore. Study after study found that many professional fund managers failed to outperform the benchmarks they were paid to beat. Professionals, with teams of analysts, advanced research, and access to information unavailable to ordinary investors. If experts struggle to consistently win the game, what exactly are everyday investors trying to accomplish? That's when investing starts to look less like a contest of intelligence and more like a contest of discipline. The investors who succeed often appear boring. They automate contributions. They ignore most headlines. They rarely trade. Sometimes they do almost nothing at all, which sounds easy. Until the market drops 20%. Then doing nothing becomes one of the hardest things in finance. Moments of caution, moments of fear, moments of certainty. Compounding doesn't care. It simply records every interruption and calculates the bill later. Dalbar gave this phenomenon a name. The behavior gap, the distance between what investments earn and what investors actually keep. It's one of the most persistent findings in modern finance, and one of the least discussed, because it points to an uncomfortable conclusion. Most investors are not defeated by markets. They are defeated by their reactions to markets. The problem isn't information. There has never been more information. The problem isn't access. Markets have never been more accessible. The problem is emotional decision-making under uncertainty, buying after confidence returns, selling after fear arrives, reacting instead of enduring. And every time it happens, a little more future wealth quietly changes hands, not to another investor, not to Wall Street, to time itself, because the market can recover from a crash. The biggest investing advantage has never been a secret stock, or a hidden strategy, or a perfect prediction. It's the ability to remain invested when every emotion is demanding action. The 8-point gap in 2024 wasn't unusual. It was the latest version of a pattern that has repeated for decades. Different headlines, different crises, same mistake, and in nearly every case, the decisive moment looked surprisingly ordinary. A quiet room, a glowing screen, a number moving in the wrong direction, a hand hovering over a button. The market was never the hardest thing to beat. The hardest thing to beat was the person staring back from the reflection in the screen.